Hello students, welcome back to Accounting 1304, Introduction to Accounting 2. This is Dr. Mercado speaking, and in today's lecture we are going to be covering a problem from Chapter 18, which deals with accounting for long-term assets. Just a friendly reminder that before you begin working on your problems, that you do read the entire chapter. A reminder that 2 attempts are provided and the highest grade is always retained. Okay? In accounting, we don't learn much by listening. We learn the most by doing. The more you practice, the better you're going to get at it. So please utilize those 2 attempts. It will not only help you to try to strive to earn a better grade, but get more practice as well. Okay? Now let's go over the problem that we're going to be covering. The problem deals with the straight line, declining balance, sum of the year's digits, and MACRS methods of depreciation. Okay, so in this problem we have a machine that is purchased on January the 1st at a cost of $59,000. It is expected to serve for 8 years and has a salvage value of $3,000. So that salvage value is basically at the end of its useful life of 8 years, we are still anticipating it having a good value of $3,000, where we can either, maybe trade it in or sell it on the side, and still we get something out of it. Now, just on the side note, most of the businesses that I've worked for, I worked for several maquiladoras, they had the habit of depreciating their assets to zero. There was no salvage value. And if we did decide to sell or upgrade or whatever the case might be, we would just take that as a gain kind of a thing. But in this particular case, there is a salvage value associated with the machinery that we have to take into consideration. Now, using the information provided, we are to prepare a schedule showing the depreciation for each of the 8 years and the book value at the end of each year using the following methods. Okay, we're going to start with the straight line, then we're going to do the double declining balance, and then the sum of year's digits, and then we are going to assume a 7-year class of property to compute the MACRS depreciation expense for each year of the asset's life. Okay, now my recommendation to students is to read, and as you're working specific problems that you focus on your section, the problem usually has the learning objective that we're focusing on. In this case is learning objective 3 from the chapter. So that way you can go to that section of your ebook and be able to read over those particular sections. Okay, so let's begin by doing a quick overview of what is depreciation. Okay, so the purpose of depreciation is to match a plant's assets cost with the revenues it helps to produce. Okay, usually what we've been doing in the past is we've been doing an adjusting entry for the depreciation, which entails debiting depreciation expense and crediting accumulated depreciation. And we've been doing this since Introduction to Accounting 1. That is the journal entry to account for the depreciation. Now we're going to learn different methods to calculate that depreciation. Okay, so we just need to also keep in mind that depreciation is a process of cost allocation, not a process of valuation. Okay, cost allocation will help us obtain the book value of the asset. Now, the book value has nothing to do with the market value. Okay, the market value is what the demand, depending on the product that it is, how much it's worth in the market. Okay, the book value is how much is worth to us in our company based on what we paid for it and what it has been depreciated based on its use and the depreciation method that we elected to use. Okay, the recognition of depreciation is not intended to make the assets reflect their market value, has nothing to do with market value. It's just purely to calculate the book value of each specific asset. Okay, so let's tackle one at a time. We're going to first learn work on the straight line method. Now, the straight line method is the simplest method, and it is the method that is used most widely by most companies because of its simplicity. Okay, so as stated, the straight line method is the most popular method for financial reporting, and the actual calculation of it is extremely easy. We're going to get the cost minus the salvage value divided by the estimated useful life. That's going to give me my annual depreciation. The annual depreciation will be the same for every year, regardless of how much you use that piece of equipment. It is, a standard depreciation amount per year. Okay, so From figure 18.1, we can see a variety of ways that we can calculate depreciation. 89% of the organizations use the straight line method. Okay, very simple to do. So let's go ahead and apply this method to the problem. Okay, so we've got 8 years to worry about. So let's fill that in with the 8. Okay, 8 years. Okay, now we need to calculate the annual depreciation. And if we look at the formula, it's cost minus salvage value divided by useful life. Okay, so let's get our calculator. The cost of the asset is $59,000. I'm going to subtract the salvage value of $3,000. That's going to give me $56,000. That is known as a depreciable base. And I'm going to divide that by the useful life. In this case, it is 8 years. So my annual depreciation will be $7,000 per year. Okay, that will be for every year, the same amount every year. Okay, so I'm going to go ahead and I'm going to put that in because I am using Excel. I just copy and paste that down, $7,000. Okay, now we have to calculate the ending book value. Okay, for the ending book value, we're going to go ahead and we are going to get our calculator. We're going to get the cost of the asset, $59,000, and we're going to subtract the depreciation for year 1. That's going to give me $52,000 as the ending book value. Okay, so when we are calculating the book value, we get the cost minus the depreciation for year 1. That will give me $52,000. Now for year 2, we're going to just go ahead and get the prior year's value of $52,000, and we're going to subtract the $52,000 minus $7,000 from year 2. That's going to give me an ending book value of $45,000. So at the end of year 2, my asset is worth $45,000. Okay, so this machine is now worth $45,000 in my books as of year 2. We continue the trend, and I'm going to use the formulas here because I'm using Excel. It just makes it so much simpler. I'm going to get my prior year's book value minus my annual depreciation for year 3. That gives me $38,000. Then I'm going to get my $38,000 from last year minus my depreciation for this year. That's going to give me $31,000. So you always start with your ending book value minus this year's depreciation, and it'll give you your ending book value. Okay, so we repeat the process. Okay, and we continue doing it. So we get to year number 7. Okay, now in year number 7, my book value is $10,000. I'm going to go ahead and I'm going to subtract my $7,000, and it leaves me a book value of $3,000. Okay. Now, that book value, that ending book value needs to agree to your salvage value, okay? You cannot depreciate it to 0 because it has a salvage value. So at the end of year 8, I have to have $3,000 left over of what this piece of machine will be worth in our books, okay? So just remember, when you are doing your depreciation using the straight line, if a salvage value is provided, that salvage value should be your ending balance the last year of depreciation. Okay? Fairly straightforward. Now let's do the double declining balance. This one's a little bit more complicated. Okay? So the double declining balance method. This is a more aggressive way of depreciating your assets. You're basically depreciating your assets at double the rate of your straight line method. Okay, so some individuals believe that depreciation expense should be higher in the early years of when we acquire an asset. Therefore, the depreciation should be higher those terms because it's either used more because it's at the beginning, or it's just a way of people believing that an asset should be depreciated at a faster rate when it's purchased than in the later years. As the asset wears off, we anticipated it's going to be breaking down more or whatever the case might be. So they tend to heavily depreciate those assets at the beginning. Okay. So This is a method that they provide, the double declining balance method, okay? So the double declining balance method, the annual depreciation is obtained by getting the depreciation rate times the book value at the beginning of the year, okay? So what happens here is this method results in higher depreciation at the beginning, smaller depreciation at the end, okay? Now, when we are calculating depreciation, what we did for the straight line method is we had that 3,000 residual value factored into our formula, right? We deducted salvage value from our cost. When we're dealing with the declining balance, we don't make that deduction at the beginning. We do it at the end, okay? We take into account the salvage value at the end. Now, something very important to note when we are dealing with the double declining. There might be situations where we are required to depreciate the asset for a longer term than anticipated, okay? So let's read this section in your book, okay? It says the salvage value is not considered in determining the annual depreciation. So we don't take into account the salvage value. However, the asset's book value should not be allowed to fall below its estimated salvage value. So that last and final year when we calculate depreciation, we need to make sure that we always keep that salvage value as the ending balance. Okay? Now, this is very important. If the book value is still greater than the salvage value at the end of the last year, the process continues until the book value is reduced to the salvage value in subsequent years. Okay, so if we reach, and that's what's going to happen in this problem that we're doing, if we reach that final year, and in the problem it's year number 8, if we reach year 8 and we still have a large enough book value, we need to continue depreciating it until we're able to depreciate it to the point where we get to that 3,000 salvage value. Okay, so let's go ahead and do that calculation. Now, remember, for the depreciation, we're going to get the depreciation rate for the straight line and simply duplicate that. Okay, so what we're going to do is we are going to get let me get the calculator. Okay, the rate for the straight line method is, we are going to divide 1 year by the total number of years. In this case, we have a total of 8 years that we're depreciating it. So using the straight line method, my depreciation rate would be at a rate of 12.5%. Okay. Now, we are doing the double declining balance rate, which basically means we're going to double that, okay? Therefore, using the double declining balance, my depreciation rate is going to be at 25% per year, okay? So let's do it again. How is she getting that? First, we have to calculate the straight line depreciation rate, okay? To calculate the straight line, you always start off with 1 divided by the number of years that we are expected to have this asset. In this problem that we're working on, we are going to have this asset for 8 years, so we're going to divide by 8. So that gives me a percentage of 12.5% or 0.125. Okay, that is my straight line rate. Every year I would depreciate it that much. Okay, now I am going to double that rate because we are doing the double declining balance. I'm going to multiply by 2 to double it, and that gives me 0.25. That is the rate I am going to be depreciating my assets, okay, at 25%. So let me copy that over. My rate will not change, okay, but my amount of the depreciation will, because my book value will change, okay. So I've got, and I'm going to stop there, okay. So your beginning book value will be the cost, because we do not take, when we are doing the double declining balance, we don't take into account the salvage value at the beginning. We take it into account at the end. So we're going to get the cost of $59,000. Okay, we're going to multiply it by the rate, 59,000 divided by 0.25. Let me see if I did it right. That times that. Okay, there it is. I don't know where the number was coming from. 14,750, that is my depreciation for year number 1. So my ending book value would be your beginning book value minus your annual depreciation, and that will give you your ending book value. Now your ending book value, you're going to bring it down to the next year, to year number 2. That's going to be your starting point. You're going to get your beginning book value times the rate, and that's going to give you your annual depreciation. We're going to go ahead and we're going to get the beginning book value minus the annual depreciation, and that will give me my ending book value. That ending book value, we're going to carry it down to the next year. Once we carry it down, we simply do the math. Beginning book value times the rate, and that's going to give me my annual depreciation. Ending book value would be your beginning book value minus your annual depreciation, and that will give me the $24,890.63. You will repeat the same steps, okay? I'm going to do that a little bit quick, okay? And I think I can copy the formulas down, okay? So I'm just going to bring those down, and because I am using Excel, we can pre-populate the, like just copy the formulas and it'll do it for you, okay? So at the end of year number 8, because they're asking you to calculate the depreciation for 8 years, my ending book value is still at $5,906.66. Now my salvage value is $3,000. Okay, now this is what the homework problem is asking you to do. 8 years. But if you recall from the textbook, okay, it says if the book value is greater than the salvage value at the end of the last year, the process continues until the book value is reduced to the salvage value. Okay, so sorry about that. So, oh my God. Okay, so because I still have a book value of $5,906.66, I will continue to depreciate it past the 8 years until I bring that balance down to $3,000. So let's see what happens on year number 9. I'm going to bring down my ending book value. I'm going to go ahead and I'm going to copy my formula down, okay? And as of the end of year 9, I still have an ending balance of $4,430 and my book value for that asset. Let's depreciate it one more year. I'm going to bring my balance down. Okay, I'm going to multiply it by 0.25. Okay, at the end of year 10, my book value is $3,322.50. So that's very good. We're almost there. This is the last and final year that we depreciated. I'm going to bring my total down. Just copy it, okay? Now, the last year, I'm not going to multiply by a rate, but rather it's going to be a pre-filled or a plug kind of a thing. We're going to plug in the number that we need to depreciate to get to my 3,000. Remember, at the end of the day, we need to get to that 3,000, which is my salvage value, okay? So I know that, let's get our calculators. I know that my salvage value should be $3,000. My book value is $3,322.50. I need to get to 3,000. So that means that this year I am going to depreciate my asset $322.50. Okay. By having that depreciation, that will arrive at the 3,000 salvage value that I need to get to. Now in this particular situation, the problem is only asking you for 8 years. Okay. Up to that point. I am illustrating to you what would happen in the case where that ending book value does not reach that target salvage value of 3,000. It's too high. If it's too high, we continue depreciating the following years until we reach that mark of 3,000, which is the salvage value in this problem. Okay, so fairly straightforward. You're simply going to get the book value less the annual depreciation to get the ending book value, and then you bring down the ending book value, multiply it by your rate to get the annual depreciation. To get the ending book balance, you get the beginning book balance minus the annual depreciation, and that will give you the ending book balance. Okay? And the rate, how do we calculate the rate once again? We calculate the simple, like if we were doing the straight line method, 1 over 8 years. gives me a rate of 0.125. I double that, and that gives me my rate of 0.25. Okay? So that is the double declining balance method. Now we're doing sum of the year's digits. Okay? For the sum of the year's digits, we have some formulas that we have to apply. So, sum of the year's digits is determined by this formula that we have. The cost minus the salvage value times the remaining useful life from the beginning of the current year divided by the sum of the digits. To calculate the sum of the digits, you have to use this formula. The sum of the digits is equal to n times n plus 1 divided by 2. N is the number of years of the estimated life. Okay, so we're going to be calculating this formula or using this formula to calculate the sum of the years. Okay, so in this particular case, we're going to get N. The number of years that we're going to be using it is 8. Okay, multiply it by 8 plus 1. Okay, and then we are going to divide it by 2. Okay, and let me make this a little bit bigger. And then that will give me the sum of years, sum of the digits. Okay. So the sum of the digits is 8, n times n plus 1. N is the number of years of the estimated life, and in our problem, that is 8 years. Okay, so we're going to do the order of operations. We first do the inside. 8 plus 1 gives me 9. 9 times 8 gives me 72. 72 divided by 2 gives me 36. That is the sum of digits. Okay, the sum of digits is 36. Okay, that is the number that we're going to be using for my sum of digits based on this formula, 36. Okay, so down here we have information. The numerator in any year is the number of years remaining life for the asset measured from the beginning of the year. So what we're going to do is we're going to start off with the rate. Okay, we've already calculated the sum of years, which is 36. Okay, that is going to be my denominator. The denominator for all fractions is the sum of years. Okay, that is what we calculated. The numerator is the year and the number of years remaining life for the asset measured from the beginning of the year. Okay, so how many years are remaining to depreciate in year 1? We're going to have 8 over 36. And let me put this as, let me see if it doesn't, how can I explain it? It reduces it for me, and I don't want it to reduce. I want it to show. Let me see if I just do number, if it'll allow me to keep the 836. It'll change it to a rate. I don't want it to be a rate. What if I use a just text? Let me see. 8 over 32. There we are. Okay, so what I was trying to do is just keep it as is. So it's going to be 8 at 32, 7 at 32, 6 at 32, 5 at 32. The number that we calculate in the sum of years, that will always be your denominator. Okay, and then the number of years remaining are going to be going down in order. So the first year we have 8 years remaining. The second years we have 7 years remaining, 6 years remaining, 5 years remaining, so on and so forth. Okay, so that is the rate that we're going to be using. Okay, so those are the rates. Okay, now the depreciable cost is the cost minus the salvage value. Okay, so it will be the cost of 59,000 minus the residual value of 3,000. So that's going to give me a depreciable cost of 56,000. You are always going to multiply the rate by the depreciable cost. Always. The depreciable cost will not change every year. The depreciable cost will remain the same, 56,000. Okay? Now, what we're going to do is we're going to calculate the annual depreciation. I'm going to get my calculator for that. Okay? We're going to get the 56,000 times 8 divided by 32. Okay, let me see. I believe that, let me see, let me do the calculation one more time. Times, oh, I'm sorry. I put 32 and the number's 36. I was like, why is my calculation off? Okay, so we had calculated the sum of digits, which was 36. I just typed all of them wrong. It should be 36 here. Okay, let me fix that real quickly. You see how easily we can make a mistake? And that's because I had calculated it on the other sheet. I was like, why are my numbers off if I had calculated them already? Okay, so before I go through this, I do my calculations ahead of time so I can make sure that my numbers tie to what they should be. Okay, so I'm sorry, the rate should be the number of years that are pending from year 1 going down divided by the sum of years, which is 36, which we had calculated down here, which was the 8 times 8 plus 1 divided by 2 gave us that 36 using the sum of the years digits formula. Okay, so remember, if you do the calculation, make sure that you copy the right number. If not, everything will be wrong. Okay, so now that the item has been fixed, we can go ahead and proceed. Okay, we've got the 56,000 times 8 divided by 36. That will give me 12,444.44. Okay, that's going to be my annual depreciation for year number 1. Now, to calculate the ending book value, you're going to get the actual cost of the asset. Be very careful. Okay, to calculate the annual depreciation, you obtain the depreciable cost, which is your cost minus your salvage value. To calculate the ending value, we're going to start off with the cost, which is 59,000 minus the 12,444.44. Okay, and that's going to give me an ending book value of 46,555.56. Okay, so that was 46,555.56. Oh, sorry about that. It moved. Okay, 46,555.56. Okay, so once again, that is very important because that is what throws students off. You know, what they tend to do is get the 56,000 minus the annual depreciation. That's not going to give you the right amount. So remember, to calculate the annual depreciation, you use the depreciable cost, which is your cost minus your salvage value. To calculate the ending book value, you pick up the cost. How much did you pay for this machine? 59,000. Okay, minus my annual depreciation of 12,444.44. It will give me an ending book value of 46,555.56. Okay, we're going to proceed with the annual depreciation for year number 2. We're going to get our calculators out. 56,000 times 7 over 36. That's going to give me a depreciation of 10,888.888888, whatever. Okay, we're going to look at the third digit. The third digit is an 8, which is greater than 5. If that third digit is greater than 5, we round up that second digit to a 9. So this will be 10,888.89. Please be careful with your rounding. Okay, 888.89. Okay, now we're going to go ahead and we're going to get the ending book value of 46,555.56 minus year 2 depreciation of 10,888.89, and that will give me an ending book value of 35,666.67. Okay, year number 3, we're going to once again get our depreciable cost of 56,000 times the rate. This is year 6 over 36. That's going to give me an annual depreciation of 9,333.3333. Because that third digit is a 3, we're going to keep that second digit as is. We're not going to round up. We're going to keep it. Okay, so my annual depreciation will be 9,333.33. Okay, to get our ending book value, I'm just going to do it here for simplicity purposes. We get our ending book value minus our annual depreciation, and that will give us 26,333.34. Okay. Okay, so we continue with the process. 56,000 times 5 over 36. That will be 7,777.77777. Because that third digit is a 7, we're going to round up that second digit to an 8. So it'll be $7,777.78. Okay, $7,777.78. So to calculate the ending book value, we pick up the prior year's book value minus the annual depreciation, and that will give us 18,555.56. We're going to do year number 5. We're going to get the 56,000 times 4 over 36. I think I missed a number. Let me see. 56,000 times 4 over 36. That will give me 6,222.22. That is going to be my depreciation. 6,222.22. The ending book value, we're going to pick up last year's ending book value minus the annual depreciation. That'll give me 12,333.34. Year number 6, we're going to go ahead and we're going to get the 56,000 times 3 over 36. My depreciation will be 4,666.6666. Remember, that third digit is a 6, which is greater than 5. That means I'm going to round up that second digit to a 7. So then my number would be 4,666.67. Okay, we're going to get our ending book value minus the depreciation for this year, and you'll give us 7,666.67. We're almost done, students. We're going to get 56,000 times 2 over 36. That'll give me $3,111.11. So let's plug that in. 3,111.11. We're going to get the ending book value minus the annual depreciation, and it'll give me that. Okay. Now we're going to do the last and final one. 56,000 times 1 over 36. That's going to give me 1,555.55555. That third digit is a 5, so that means we're going to bump up that second digit to a 6. So that's going to give me 1,555.56. We subtract the ending book value from my annual depreciation, and voila, I go back to my $3,000, which is my salvage value. Okay, so remember, the whole point is at the end, that piece of equipment or machinery, whatever it is, what is it, a machine, has to have an ending residual value of $3,000. Okay, so that is the sum of the year's digits. Remember, to calculate the sum of the digits, that would be your denominator. Your numerator would be the how many years are pending. So for year number 1, the entire 8 years are pending to be depreciated. For year number 2, 7, 6, 5, 4, 3, 2, 1. The 36 will remain constant for all of them, and that is the number that you calculate using the formula for the sum of the year's digits. Okay? So fairly straightforward. Once you do that, the only other thing that I want to remind you is when you calculate that ending book balance for the first year, make sure that you subtract the cost. Not the depreciable cost, but the actual cost. How much did you pay for this machinery? Well, I paid $59,000. I'm going to subtract my annual depreciation, and then that will give me my beginning ending book value. And from that point forward, all you have to do is get your ending book value minus your annual depreciation to get your ending book value. Okay? So those are the 3 different depreciation methods. As you can see, the depreciation will be the same. You're still going to depreciate $56,000 of of the machinery, because $3,000 will be the salvage value. The only thing that changes is the method that we use, how the depreciation will impact. For example, the straight line method, every year the depreciation will be 7,000. It will not change. Using the double declining balance, my depreciation is very aggressive at the beginning. We go from 14,000 all the way down to 1,968 for the 8th year. Okay, so our depreciation is very high the first couple of years, and then it starts dwindling down. Okay, for the sum of the year's digits, also aggressive at the beginning, and then it begins to dwindle down towards the end. Okay, but at the end of the day, depreciation will be the same. It's just how it's allocated over the years. And that is where companies decide what method suits them best for whatever reasons, whether it be for tax purposes or whatever reasons that they decide. Okay? Now, the second requirement is assuming a 7-year class of property, compute MACRS depreciation expense for each year of the asset's life. Okay? So there is a section on your book that deals with MACRS, okay? Depreciation for federal income tax purposes. A business is allowed to deduct depreciation expense when calculating taxable income on the tax return. Several depreciation methods are allowed under the tax law. Tax reforms enacted in 2017 allowed businesses to bonus expense 100% of the cost of most assets, not including buildings, acquired and placed into service after September 27, 2017. Okay, that bonus is expected to fall off, as you can see. Okay, after 2026, no further bonus depreciation is planned. Okay, for plant assets acquired earlier but after 1986, either the straight line method or the modified accelerated cost recovery system, which is known as MACRS, may be used. So, for tax purposes, you can only use straight line or MACRS. Okay, MACRS identifies 8 categories of useful life for plant assets ranging from 3 to 39 years. Most business assets, other than real estate, fall into one of 2 categories, either the 5-year or the 7-year property. Okay, and the rates are set by the IRS. Okay. When using these rates, salvage value is ignored when determining the depreciable cost. This permits a 100% write-off of the original cost. Okay. So, they give you the schedule for the MACRS, the depreciation rates for the selected assets. So they give you a predetermined rate depending on the type of asset it is. 3-year, 5-year, 7-year, 15, 27.5, or 39. Okay, and then they give you the types of assets that fall for those categories. Okay, now in the problem, they're telling you that we're going to assume a 7-year class of property. Okay, so the 7-year class of property is right here. Okay, we're going to be using these rates right here. So I'm not coming up with numbers on my head. No, I'm not. It is coming straight from your book. We just need to locate the 7-year mark, and these are the rates that we are going to be using. Okay, so having said that, I have already printed this figure out because I cannot remember all of these numbers from the top of my head. So I printed that out because I am going to transfer those numbers into my table over here. Okay, so all I'm going to do is I'm going to bring in those numbers and I'm going to copy the rates, 1429, 2449, so on and so forth. I'm just going to copy and paste that over here. Okay, copy and paste. So we're just going to copy and paste the information. I'm not doing any math yet. I am just going to copy the data so we can do our calculations. So let's do the copy and pasting of the data. 893, 892, and 893, and 446. Okay. So these rates, once again, where did I get them from? I got them from the table. Okay, from figure 18.3. Copy and paste, and they told us to use the 7-year. That is why we're focusing on this. Okay, we are provided with the information in the problem to use the 7-year class of property. Okay, now that I've copied and pasted my rates from the figure, I can go ahead and bring in. Remember, when we are using the MACRS system, we do not take into account the salvage value, only the original cost. The original cost of this equipment is $59,000. I'm going to copy and paste that over. Okay. So now what we're going to do is we're simply going to multiply the original cost times the rate. Okay. And then that will give you the amount, okay, of depreciation per year. Okay. So because I am using Excel, I'm just going to copy the formula down. Voila, it's all done for me in a piece of cake. Okay. So to copy the formula, enter the formula in the first cell, which I did. I entered, if you see here, I entered the original cost times the rate. Once you enter the formula in the first cell, there's a little box in the corner. You just grab that box, take it down, and the formula will be copied. You see, and then if you click on it, it will automatically update the formula. Okay. So I encourage you, for these types of problems that there have a lot of calculations, to create an Excel template if you are familiar with it. Most of students nowadays have been exposed to Excel for many years, since high school or whatever. Please use it. It will really help you out. Okay, now that we've done that, I am going to calculate my total. So the total that I depreciated over the 8 years should be the, oh, sorry about that, should be the $59,000. Let's see if it matches. And yes, it does. So the $59,000, which is what I paid for the machinery, is going to get depreciated using the rates provided by the IRS based on the category of property. And this is how we're going to depreciate it every year. Okay. So if we recall, you know, for planned assets acquired before earlier, but after 1986, organizations have the option of either using the straight line method or the MACRS method. Okay, so if your company is, let's say for example, using the double declining or the sum of the year's digits, these are not allowed. So you would have to rerun your calculation using the straight line or the MACRS system. Okay, and I guess that is why the majority of the organizations use the straight line. That way they just have to do one calculation for purposes of calculating depreciation for either tax purposes or for their business purposes. Okay, they just use the straight line method overall. Okay, but basically these are the different calculations using the three different depreciation methods: straight line, double declining, and the sum of years. And we also compared it to using the MACRS depreciation formulas based on the tables provided. Okay, so these are all of the calculations. I hope it helps you out in solving your homework problem. This problem will be on your exam, so make sure that if you have questions, you reach out to me. I believe that in your homework, you are only required to calculate the 8 years for when you're doing the double declining. The other is just additional information to fully show you how to depreciate the asset until it reaches the residual value. Okay, so that is it for this problem. Questions or concerns, please do not hesitate to reach out to me. I have office hours scheduled. Send me a Blackboard message, an email, a pronto message, and I will try to get to you as soon as possible. I encourage that you all form study groups. That way you help each other out as you're working your homework problems. Help answer questions you might have. That way they will better help you prepare for when the exam comes along. Okay, so that is it for lecture for chapter 18. Until next time, have a wonderful day.